there's a lot of joint ventures going on all the time, but how many deals have the partners actually done together? Right. In our case, we've been together since 2017. We've done 21 deals. We bought and sold a bunch. Right. So the track record as partners together is really important. Welcome, everybody, to the webinar. Today, we're going to talk about how to do due diligence on a real estate syndication. We're going to use a case study to do that. And here's what we're going to cover is really due diligence, well, like I said, on real estate syndications. And we want to know, hey, what are the things to look for? When you get a deal, on a real estate syndication as a passive investor, what kind of deal are you what should you look for, right? So we're going to talk about things to look for like market and location, but what about the business plan itself? What about the financials, what to look for there? What about the underwriting assumptions? What about the risk, right? So fundamentally, are an operator's projections really achievable or overly optimistic? And that's kind of what we're going to talk about here today. And it's going to be via a case study that we're going to go through and teach all of these concepts here as well. So if you haven't we haven't met before, my name is Michael Blanca. I'm the host of the Financial Freedom with Real Estate Investing co-host, because my co-host is Garrett Lynch, who's also on, and author of the book Financial Freedom with Real Estate Investing. And together with Garrett and our other partner, Drew Niffin, own about $300 million in real estate. And if I can get my notes up here, that would be even better. And Garrett Lynch is our co-host on the Real Estate Investing podcast as well. He's had an interesting career, had a bunch of stuff, cool things happening, Chicago nightlife, and he's got a marketing degree, and in the previous life actually collected about 3,400 multifamily units across 10 markets as well. He's traveled a lot. He's the co-host of the podcast. I mentioned that before, and he's a partner at Nighthawk Equity. So with that, welcome, Garrett. What's going on?
What's going on, Michael?
Yeah, so we're going to talk all about here about doing due diligence when you get a deal across your desk. And we're talking to both passive and active real estate investors, because it's important to know both of these things. If you're an active investor and you're marketing a deal, you have to know what you want to put in there and what the investor is paying attention to. And if you're a passive investor, here are the things to look for, right? And so the question really becomes, how much due diligence should an investor do on a deal, Garrett? Like, what do you think? Do they have to become an expert at underwriting, attend some kind of course, or what are your thoughts about from a passive investor? And if you're an active investor, how much education should you really do?
Well, I think due diligence is extremely important. And so I've done the business two ways. I've done a business where we go and buy assets in many different markets across the country and never really learn them on a deeper level. And I think that's a disadvantage. So you can go wide and go across the country and just chase yields, or you can go deep in a couple markets and really learn block by block what's going on. And I think that gives you an edge. So when you're going into due diligence, you're not just doing due diligence on the property, you're doing due diligence on the location, on the demographics, on who are these people and why do they want to live where you're about to buy something. And so really understanding that on a deeper level just ups your chance of being successful once you get into the actual purchase of the property and the operations of the property. And so, yeah, it's you have to do it. We've turned down deals and killed them because they didn't pass our due diligence test. And you can't cut corners. It's really easy to see the money on the other side and say, oh, we're going to make all this money. And then you overlook some things maybe that you shouldn't have. And then you get into more trouble later when you can't actually execute on your plan. So got to stick to your guns when you're in due diligence, and you really want to go deep.
Yeah, one of the benefits of being a passive investor is that you don't have to do due diligence yourself. I know what Garrett's talking about. We spend a lot of time and money doing due diligence, and the advantage of being a passive investor is that you don't really have to become an expert. You don't have to know how to underwrite deals and things of that nature, but you should be able to ask questions. And what we want to do here on the show today is teach you kind of what questions to ask and what answers to look for. So when you're getting a live deal coming across your desk and you want to passively invest, or you're an active investor, you're an operator, and you're marketing a deal, there's really three aspects of doing the due diligence. You really want to look at the asset, the operator, and the deal itself. You want to look at the asset class first, then the operator, and then the deal itself. So what I mean by the asset class first is how fundamentally strong is the asset class? In this case, it's multifamily, right? So is it fundamentally strong? Is it a good time to invest? And what is the prospect for the future? So let me talk about that really quickly. For us, the one of the reasons we picked multifamily investing was because the fundamentals are strong. They have been for many years, and they'll continue getting stronger. Now, they're temporarily undervalued for a variety of different reasons, interest rates rise, things of that nature. But if you look at the fundamentals, there's an extremely strong demand for affordable housing. And it's not going to get any better because you can't build more affordable housing, right? So there's a growing population chasing essentially a limited affordable housing stock, and that is over time going to drive up the rents. We like that in an asset class. We also like how it has performed over the last 50 years in various recessions. During recessions and down cycles, we don't get a huge spike in vacancies and a giant drop in rents. We get a flattening of those. They may not be going up, but they're not crashing either. So asset class is very important consideration. That's why we still love the multifamily asset class. And the second one is the operator, because what Garrett was talking about, all these considerations in getting due diligence, is you can do all those things, but the biggest thing is if you pick the right operator, it'll be taken care of. If you pick the right operator, that operator is going to pick the right market. They're going to pick the right asset in that market. They're going to do the due diligence. They're going to pick the right property manager. So it's definitely a who, not how mentality, like the book by Dan Sullivan, is picking the right who will take care of the how. And so when you're looking at operators, a couple things to look for. Look for a track record of the partners. There's a lot of joint ventures going on all the time, but how many deals have the partners actually done together? Right. In our case, we've been together since 2017. We've done 21 deals. We've bought and sold a bunch. Right. So the track record as partners together is really important because, as you know, partnerships can be very challenging. And in our case, we've been around for long. We've had to deal with a variety of challenges that we've overcome and has made us stronger as a result. The second one is really look for true operators. And true operators are not just capital raisers, they're actually operators. They actually have in-house teams, not only investor relations, but for example, we have a construction manager who manages our construction. We have an in-house asset manager. We're basically operating our assets as well. But really look at the operator and look at their collective track record. And the last component is the deal. And we're going to talk about a case study here called Overlook Apartments. And the things to look for, to ask questions around are, for example, the business plan. What's the plan here? Like, what's the problem? What's the plan? Does it make sense? And it's not just the financials. We'll talk about the financials, the projections, which are interesting. Okay, but I can make my spreadsheet say anything I want. The question is, what's behind the numbers, the assumptions? So, for example, how conservative are my assumptions? Are they more aggressive? What is my exit cap rate? What are my assumptions around rent growth and vacancy, right? If I'm doing a value add deal, why in the world am I projecting a 10% vacancy in year one? When I'm turning over units and I'm ripping everything apart, shouldn't vacancies go up, right? And the other question to ask is, are there plenty of reserves? Not only at closing, especially if you have a larger construction budget, how do you address overages? But also, are there reserves being taken out of cash flow, right? Because if I'm not taking reserves out of cash flow, then my returns are going to be higher. So my deal is going to look better than the other deal because of that. So we're going to talk about some of these things here with this deal called Overlook Apartments. So Garrett, we're going to dust off our own deal here, and let's talk first about we're going to talk about what we liked about the deal, the business plan, what we felt the risks were, how we made it again, what were our projections, what are some underwriting assumptions, what about those reserves? And so let's get right into it. Tell us a little bit about the deal, Garrett, and then maybe what we liked about it, and maybe some things afterwards, what we didn't like. But let's give us an introduction into the deal here.
Yeah. So the first thing I usually look for when we have a deal that comes across the desk is location. If the location isn't within our buy box, we've gone deep into which areas we do want to be in and which areas we don't want to be in. We have an actual map. It's like a heat map that we've created, and it outlines, hey, this is a bad area, this is a medium, this is a good area. I'm looking at that first. So that's the first criteria that we need to look at. Hey, is this in a location we want to be in? And the reason you do that is because you want to make sure that you have every tailwind that you can possibly get, including better residents, better on-site staff, low crime. It just makes life easier. And so if you go to a bad area, like where there's high crime, and you're going to have worse tenants, low credit scores, things that just people that are, switching jobs all the time or not holding a job. And so it's hard to underwrite to that. And that's the first step. So we look at that. And on this deal specifically, Overlook Club, it was in one of the best counties in all of Georgia. And so we looked at the stats on that county. We're going deep into the numbers to start. So I'm looking at what are the demographics there? Where are the jobs? Where's the new development coming in? What is the economy like in this specific submarket? What is the median household income? All these things that you put in front to see, okay, what kind of tailwinds are we dealing with that's going to help our business plan succeed that much more? It is challenging to run these types of assets, and they're even more challenging when you have a lot of headwinds from the market. And so you have to really dig into the market first and understand, okay, what is this specific submarket going to do to my property? How is it going to help or hurt me? And so that's why when I say people that are going wide, it's sometimes difficult for them to understand the specific submarkets inside of a major market. And so you've got really three types of markets. You've got primary, you've got secondary, and you've got tertiary. Tertiary is the smallest, secondary in the middle, and then your primary markets. The advantage of being in a primary market like ours, Atlanta is our main one, is there's a really good staffing pool. So there's good labor pool in general. And these are the people that are going to run your assets. Okay. So the next thing you're going to do, and the reason we like this deal is we had that really good location, and we knew we could pick from a good labor pool to get the site running well. We also wanted to do a deep dive into just the numbers on the high level numbers on the deal. Okay. What are we doing? How is it performing right now? Sometimes deals are performing low on the low side. And then if you understand why that is, it can be a good value add play. This one was just performing steadily. So it had numbers that were in, the mid 90s in occupancy, no delinquency, which is a great sign, but the rents were just lower than the market. So this is a perfect setup. So you can go in, find a property that's a little bit dated, a little bit older, unrenovated, 100% classic units, and say, oh, there's some rent upside here if we go in and force appreciation on an asset like this in a good location with everything going for it. And so that was kind of the key catalyst to us deciding that we wanted to go into this deal. So you're looking at the macro stuff first. Then you're getting into, okay, what are the actual numbers looking like when we're putting them inside of our model? What are our assumptions? We don't want to be overly aggressive about them. We want to be as conservative as possible. Does that work inside of our model? Can we be conservative and still get the returns that we want to get for our investors? And in the instance with this deal, the answer was yes. And the reason for that is because the seller was being reasonable about pricing, and the property had a lot of upside in the renovations that you can do. So you go into these assets that are classic, completely classic. That's like a gold mine. You're like, okay, as long as the seller's going to be realistic on pricing, everything is classic. I can go in there, spruce it up. I know it's going to be worth more because people are going to be willing to pay more to be in that location.